back to results, the strong numbers that came in, or the big numbers that came in yesterday, were those from HDFC Bank. A sterling set of numbers. It's not just the NII growth and the profit growth that of course came in a tad above expectations or in line, and the market kind of brushed it aside by saying that it is as per expectations. But the real merit or the key highlight of the numbers was really the quality of the book. Anuj, actually the total amount of gross NPLs actually fell by 100 crore, and yet the company maintained the provisioning more or less at the same level that they kept in the third quarter, and that is because they just had some extra provisions, floating provisions, just buffering when the cycle changes. Clearly a sterling performance. Let's hear out the management.
Our asset quality even last year was pretty good, and probably better than what the industry NPL figures have been. But the improvements have been largely driven by much lower NPA formation across the entire range of retail loan products in particular. And that's interesting because depending on the product in retail, you do have an expected loss and therefore an expected level of NPLs. But for various reasons, which is perhaps the origination that we've been doing from our own customer base and the credit standards we've had, the incremental NPL formation on the retail side has definitely been lower than even perhaps what you expect from those products. You add to that the fact that the economy has been doing fairly well, and therefore new NPA formation on the corporate side as well has been pretty muted. And finally, there have been some recoveries because in the last couple of years we did have higher loan losses and write-offs as we sort of cleaned up the Centurion portfolio, and as we went through a slowdown. So some of those recoveries now only further add to the improvement in the asset quality piece. So yes, we've had a pretty good run and a bit of a sweet spot as far as asset quality is concerned, and that reflects in the provision numbers.
Coming to provisions, provisions although has declined, but you've made excess floating provisions. Can you give us an outlook as to going forward? You will continue making these kind of provisions aside of the NPA provisions?
Well, let me qualify that. I don't think there's anything like an excess floating provision, but yes, we have, apart from the specific provision for loan losses, we have made floating provisions. In this quarter, it was about 230 crores, so that's a meaningful number. I think this really reflects our basic philosophy that there is an inherent or expected loss in a portfolio, and you go through cycles where perhaps your actual specific loan losses might increase or decrease within a band depending on the product mix. But globally, central banks and the general feeling is that banks would be encouraged to have countercyclical buffers, whether it's in terms of capital or in terms of provisioning. We did recognize that as far as existing loan loss formation, loan losses as a result of NPA formation right now are lower than what we believe are normalized levels, and we've therefore thought it prudent to create floating provisions. Going ahead, I think depending on how the asset quality picture emerges, we would figure out whether we need to further beef up floating provisions, or whether the specific and general provisions in line with regulatory requirements or in specific provisions higher than that are adequate to reflect the asset quality that we hold.
So do these provisions include provisions made against microfinance loans and also maybe 2G loans?
No, the floating provisions are, just plain and simple floating provisions. There are specific regulatory guidelines on how those can be used. And the only flexibility is whether you knock that off to arrive at net NPAs or you treat that as tier 2 capital, which is what we've done. As far as, issues relating to, for instance, the microfinance portfolio, we have in the previous quarter itself made some, contingent provisions on a portfolio basis. That's not on a name-by-name basis or, because none of these are NPLs as of now. But I think recognizing that there is a potential issue for the system and for us as far as the MFI portfolio is concerned, and some of these names are looking for restructuring and so on, we have made some contingent provisions in any case. So the floating provisions don't really reflect that at all.
What about 2G cases? Do you have any exposure to 2G loans?
We have no exposures as far as lending exposures at all to any of these names that are in relation to the 2G piece.
Okay. HDFC Bank has been consistent in terms of maintaining its margins above 4%. And do you think going forward there could be some pressure on margins, because everybody's talking about possible RBI hiking policy rates, and therefore that could put pressure on margins for the banking industry? Do you see that happening in the first quarter next year?
Well, more than policy rates, I guess what would impact margins for the system and then therefore for us as well would be what happens to deposit rates and what happens potentially therefore to lending rates as a result of any deposit rate hikes. Clearly in the last couple of months in particular, we did see a spike in deposit rates, in particular in the March quarter, and that was on two planes. One was just retail deposit rates went up, and then you had bulk deposit or CD rates going up even more sharply. I think those peak rates are coming off now and probably will come off further. But I do believe that the retail deposit rates are likely to remain at roughly similar levels for some time. And it is likely that if some amount of rate increases are not passed on the lending side, there could be a little bit of pressure on the margins for the system as a whole. As far as we are concerned, one, we have of course seen some rate increases that happened last quarter, and we'll see what happens this quarter. We have been able to maintain our CASA ratio at somewhere in the 48 to 51, 52% range, which has remained fairly healthy, although you typically expect there to be some cannibalization from CASA to fixed deposits as rates increase. So as a combination of the deposit mix and the increase in lending rates, I believe our margins would remain in a range. They have been in that range of about 3.9 to 4.3% for a few years now, not just a few quarters. So we've been through these cycles of spikes and declines in interest rates and increases and decreases in policy rates. And as long as we can maintain the rest of the parameters I just mentioned, I think we should be able to maintain margins in a range, which is 3.9 to 4.3.
The interest rate scenario, you said if there is a possible rate hike, you will look at passing on. So does that mean even a 25 basis points hike would probably result in lending rates and possibly even deposit rates going up?
As I said, I think it can't be the policy rate in isolation. If the overall liquidity scenario, if strong loan growth, which would imply that banks need to continue to accelerate deposit growth, all these factors ultimately translate into higher deposit rates, then there is certainly a case for banks to pass on those higher deposit costs through higher lending rates. Remember, the policy rates ultimately affect only your borrowing at the margin, which is under repo, and for most banks that is not a large component of the total funding mix. So I would reiterate that it's really a function of what continues to happen to deposit rates, and if there is a lag between the last round of deposit rates and what has already been passed on, then just that lead and lag, which would determine how much and when there is any lending rate increase at all.
What is the kind of outlook on growth, credit growth going forward?
Well, I think that sort of relates back to what the expectation on GDP growth is, and you have a full range in the marketplace. But assuming that it's somewhere in the 8.25 range, then I think a system loan growth of around 20-21%, roughly 2.5 times the real GDP growth, is what is par for the course normally. And against that background, we would typically try and grow a little faster than the system. We've done that for the last several years. So somewhere in that system plus a delta is what we would look to target.